The hot topic of the moment seems to all revolve around these looming interest rate hikes and about some new terms, trigger rate, trigger point, negative amortization. Let's break all these things down and see how you might be impacted after these next rate hikes, all hopefully without being triggered. Hey, I'm Jarek Piwowarczyk, a mortgage broker in Ontario, and welcome to my channel where I demystify the mortgage process, talk home buying strategy, and help you build some generational wealth through real estate. If you're new to my channel, please consider subscribing and hit that bell icon to be notified of future episodes. Also, do me a favor and hit that like button for the almighty YouTube algorithm so this video might continue to help others be informed and make some smarter mortgage decisions. So right now we are hearing a swirl of terms regarding economy, inflation, mortgages, everything. And a lot of people are left scratching their heads asking, okay, what does this mean for me? How does it affect me? And if so, if it does affect me, what's going to happen? So to help answer that, we have to look at two main types of variable mortgages in Canada. So many Canadians use the term variable to describe a mortgage where the interest rate fluctuates. However, there are actually two distinct variable mortgages. One with a fluctuating payment called an adjustable rate mortgage, and one with a static payment called a variable rate mortgage. That variable rate mortgage is the one that we're going to be talking about today. But first, let's talk about that adjustable rate mortgage. So an adjustable rate mortgage, or an ARM, is a mortgage where the payment will change as that interest rate changes. If you used a broker for your mortgage, smart, you most likely are going to be an ARM mortgage, which, most of the lenders that we deal with have, unless you're with an institutional lender like TD. So let's look at how this works. Each part of your mortgage payment, regardless of the mortgage type, fixed, variable, adjustable, it's all made up of two parts. One that pays down the original loan, which is referred to as the principal, and the other one that pays down the interest. In an adjustable rate mortgage, when rates go down, you keep paying the principal as scheduled and you pay less interest. So overall, your payment decreases. Nice. If rates increase, on the other hand, the amount of interest you're going to pay increases, which translates into a higher payment. But since you're keeping up with the interest as it changes, your principal is getting paid down as scheduled, and you're staying on track with your original amortization. So in other words, your amortization does not change. As a refresher, and as a little aside, the amortization is the time it takes to pay down your original mortgage to zero, and that amortization typically within Canada is about 25 to 30 years for a new mortgage. This as scheduled amortization concept is really where the variable rate mortgage differs, at least for this conversation, and where all this lingo about trigger rates, trigger points, and negative amortization comes into play. Now, onto a variable rate mortgage. A variable rate mortgage, or VIRM, is a mortgage where even though the rates might change, your payments stay static or the same. If you're in a mortgage with a Canadian bank where the rate fluctuates, you're most likely going to be in a variable rate mortgage, with the exception of Scotiabank. The key feature of this variable rate mortgage is its static payments. This is the selling feature to those that want the benefits of that adjustable mortgage, but either work within a more restrictive budget or keeping an eye on the cash flow like those investing in real estate. As with any other kind of mortgage type, the mortgage payment is made up of, again, the principal and the interest portion. The static payment amount is generally set at the time of funding using that mortgage rate at the time. So let's look at those same scenarios for the variable rate mortgage. If rates go down, then less interest needs to be paid, just like the adjustable. But since your payments don't change, any remaining funds that didn't go into paying interest is going to be going into your principal. This is great because effectively you're paying down your mortgage faster, or in fancy terms, you're reducing your amortization. In times like this right now, where rates are increasing, the opposite happens. So more of that interest is being charged, and therefore more of that static payment is actually going into interest, and less is going down into your principal. This presents a problem because if you're not paying down your principal as scheduled, you won't be able to repay your original mortgage in the 25 or 30-year amortization that you agreed to. The only way of paying it off is by increasing the period it will take you to take your mortgage to $0. That's what we call the amortization. This is what's happening now, or at least will be for some people in variable rate mortgages. This leads us to the trigger rate. What is it? In the previous variable rate example, as the rates increase, that static payment, more of it was going to paying interest and less of it was going down to pay down your mortgage principal. If rates continue to rise, there would come a point where all of your payment will be going just into your interest and none of it into your principal. You are now either near or at the trigger rate. So by definition, the trigger rate is the rate at which the static mortgage payment no longer covers the interest portion of a mortgage payment. The trigger rate does not apply to adjustable rate mortgages since you're keeping up with the interest in that product. Now, if you were to do nothing at this point and rates continued to rise, the static mortgage payment that you were making would not only go 100% into interest, but there would be unpaid interest left over, not to mention that none of the principal was actually paid down. This unpaid interest is known as deferred interest and would be added to your mortgage balance. If you were to keep track like a real-time mortgage balance tracking, with each mortgage payment, your balance would increase. So when this balance starts to get bigger with each mortgage payment, this is referred to as negative amortization. Allowed to go unchecked, this deferred interest will continue to be added to your mortgage, and your mortgage balance will rise, possibly even up to your original mortgage balance one day. This is called your trigger point. At this time, your lender is getting a bit nervous on your behalf and will likely contact you with some options to get you back on track with your amortization. Now, for those of you that would like to see actual numbers of what this looks like, Canadian Mortgage Trends showed an example with an average GTA mortgage with a variable rate of prime minus 1%. So in January 2022, when the lender's prime rate was 2.45%, after the 1% discount, that rate was 1.45%, and the payment was $2,005. From this payment, $707 went to interest, while the remainder went to principal. As the rates increased by 2.25% in August, the rate changed to 3.7%, and the payments remained the same, but the amount of interest that was now owed based on that new rate was $1,804. Paying this interest amount from the $2,005 payment only left $201 to go to principal, which is hardly enough. This mortgage is nearing the trigger rate. With fall arriving, the Bank of Canada expected to raise its rates. In this example, they were saying 1%. The amount of interest owed exceeded that of the payment. So after these hikes, nothing was going to principal. And now there was even actually a $43 amount of deferred interest that was going to be added onto the mortgage. Now the trigger rate has been breached and the mortgage is moving towards the trigger point. The first individuals to be likely impacted by these upcoming rates or those rate hikes are going to be those that had a 30-year mortgage arranged in the spring of 2020, all the way up to March 2022, when the prime rate was low at 2.45%. Those with 25-year mortgages might be impacted a little bit later on. If you want to find your trigger rate, you'll have to refer to the mortgage documents that you signed at the lawyers, not the ones you were given by your broker, as these documents have to be signed in front of your lawyer. Look for a document called the Mortgage Loan Agreement, or the MLA. You can give your lawyer a shout if you don't have them, but honestly, just call your lender and ask them what that is. Calling your lender directly is really the only way to go, especially if you've made any kind of lump sum payments or you increase the payment amounts from their original amount, as all these things impact that trigger rate. In terms of solutions, the solutions offered are going to be different from lender to lender, and not all lenders have all options. But the options that might be offered to you are: number one, make a lump sum payment. Number two, increase your regular payments, which is really the most popular option. 3, convert your variable mortgage into a fixed rate mortgage using the rates du jour or the rates available at the time of conversion. Or number 4, do nothing. Now, if you choose that number 4, do nothing, this means that amortization will increase off the original schedule. And when the mortgage comes up for renewal, you will have to adjust the payment to reflect the original remaining amortization. So if you're 5 years into a 30-year amortization, you have 25 years left, that's what they're going to use for your renewal. All of this is fancy speak for your payments are going to be really high come renewal time. So you definitely want to be proactive and work with your lender to come up with a solution. Ignoring this and trying to sweep it under the rug won't help, and it could actually put you into default with your mortgage. So with all of this said, what are my suggestions? First of all, be proactive. Reach out to your lender directly and ask them what your trigger rate is. If you have the funds available, you can cut a check and make a lump sum payment, bring yourself kind of back in line. But whether you choose to do this or not, just consider increasing your payments proactively so that you can pay more of that interest and maybe kick that trigger rate down the road a bit. If you're feeling the static payment is not really your thing and you'd rather just focus on paying down your mortgage rather than keeping the payment the same, chat with your mortgage professional, like myself, about switching into an adjustable rate mortgage. You will have to generally move lenders because lenders either offer a variable or an adjustable. So consider any kind of penalties or fees that you might have to pay to do this. And finally, if all of this adjustable stuff and variable stuff is just causing you tons of stress and you can't sleep, chat about the pros and cons about maybe converting into a fixed mortgage. There are options, but you definitely want to talk about them. If you're in a variable rate mortgage and you know what your trigger rate is, please let me know what you're going to be doing as you approach your rate. If you found this information helpful, please help me on my journey to hit 100 subscribers. Please hit that subscribe button while you're here. A thumbs up is always appreciated. Until next time, be great, do good, and build wealth.